A golden surge. Prices reach new heights. Gold is shining brighter than ever. Prices have surged to unprecedented levels. In February 2025, gold soared past $2,900 per ounce. This marked a historic moment for the precious metal. Experts believe this is just the beginning. J.P. Morgan, a leading financial institution, predicts gold will reach $3,000 by the end of 2025. This bullish outlook reflects gold's enduring appeal as a safe haven asset. The recent surge in gold prices is no coincidence. It's a confluence of global events and economic factors. These factors have driven investors toward the security of gold. Gold has always been a safe haven in times of uncertainty. Today's geopolitical landscape is no exception. The return of President Trump has added another layer of complexity to the market. His policies, particularly on trade, have historically moved markets. Investors are closely watching his administration's actions. The impact of these actions on gold prices remains to be seen. Geopolitical tensions, fueling the fire. Geopolitical risks are escalating around the world. These risks are creating uncertainty in the global economy. Investors are seeking stability amidst this turmoil. Gold, with its historical resilience, offers a safe harbor. Trade tensions, particularly between the US and China, are contributing to this uncertainty. President Trump's proposed tariffs on metals have further fueled the gold rally. In December 2024, when tariffs were announced, gold futures jumped. They rose 2% above spot prices, signaling investor anxiety. Silver, another precious metal, experienced a similar surge. Its futures prices rose 3% above spot prices. These reactions underscore the sensitivity of precious metals to trade policies. Tariffs disrupt the global flow of goods. This disruption can lead to price instability and economic slowdowns. Investors often turn to gold as a hedge against these risks. The uncertainty surrounding trade policies keeps gold prices elevated. Central banks speak. The sound of gold. Central banks are major players in the gold market. Their actions have a significant impact on gold prices. In recent years, central banks around the world have been buying gold. This buying spree has been driven by a desire to diversify reserves. For the third consecutive year, central banks bought over 1,000 tons of gold in 2024. This sustained demand from central banks signals their confidence in gold. China, a major economic power, has rejoined the gold market. In November 2024, China's central bank resumed gold purchases. This move, after a period of inactivity, surprised many analysts. China's return to gold buying is significant. It signals a potential shift in global reserve strategies. Central banks are increasingly viewing gold as a stable asset. This shift in sentiment bodes well for future gold prices. Investor confidence, riding the golden wave. Investor sentiment is another crucial driver of gold prices. When investors are optimistic about gold, demand rises, pushing prices higher. Current investor sentiment towards gold is decidedly bullish. This optimism is reflected in the record high long positions in COMEX gold futures and options in 2024. Investors are betting on gold's continued rise. They are drawn to its safe haven status and its potential for growth. Low interest rates also make gold more attractive. Gold, unlike bonds, doesn't pay interest. However, in a low interest rate environment, the opportunity cost of holding gold decreases. This dynamic makes gold a more appealing investment compared to low-yielding bonds. The combination of safe haven demand and low interest rates is a potent mix for gold. As long as these conditions persist, investor appetite for gold is likely to remain strong. This sustained demand will continue to support gold prices. Section 5. Futures versus ETFs, a tale of two investments. Investors seeking exposure to gold have several options. Two popular choices are gold futures and gold ETFs, or exchange-traded funds. Each investment vehicle has its own set of characteristics. Gold futures are contracts to buy or sell gold at a specific price on a future date. They are traded on exchanges like the COMEX. Gold ETFs, on the other hand, are investment funds that track the price of gold. They are traded on stock exchanges. Section 6. Liquidity and leverage. Navigating the gold market. One key difference between gold futures and ETFs is liquidity. Liquidity refers to the ease with which an asset can be bought or sold without affecting its price. Gold futures markets are known for their high liquidity. The average daily volume of gold futures contracts traded far exceeds that of gold ETFs. This high liquidity in the futures market ensures that investors can easily enter or exit positions. It also contributes to tighter bid-ask spreads, benefiting traders. Another important distinction is leverage. Futures contracts offer built-in leverage. This means investors can control a large position with a relatively small amount of capital. Leverage can amplify returns, but it also magnifies losses. Investors need to be aware of the risks associated with leverage before trading futures. Section 7. Tracking errors and physical delivery. Weighing your options. Tracking error is another factor to consider when choosing between gold futures and ETFs. Tracking error refers to the difference in performance between an investment fund and the underlying asset it tracks. Gold futures, due to their direct link to the price of gold, have minimal tracking error. Gold ETFs, on the other hand, may experience some tracking error. This error is typically attributed to management fees and expenses incurred by the ETF provider. Finally, both gold futures and ETFs offer the option for physical delivery of gold. However, the process for taking delivery differs. ETFs typically have higher minimum investment requirements for physical delivery. They may also involve additional administrative procedures through the investor's brokerage firm. Section 8. Uncertainties loom, navigating the path ahead. While the outlook for gold appears bright, uncertainties remain. The ongoing trade war between the United States and China casts a long shadow over the global economy. The ultimate impact of these trade tensions on gold prices is still uncertain. The future direction of United States monetary policy is another wildcard. The Federal Reserve's decisions on interest rates will influence the attractiveness of gold relative to other assets. If interest rates rise significantly, gold's appeal may diminish. The level of central bank gold purchases is also a question mark. While central banks have been aggressively buying gold in recent years, this trend may not continue indefinitely. A slowdown in central bank purchases could put downward pressure on gold prices. Section 9. Conclusion: the enduring allure of gold. Gold has been a store of value for millennia. In today's complex and uncertain world, gold's allure remains as strong as ever. Geopolitical tensions, trade wars, and inflationary pressures are driving investors toward the safety of gold. Central banks, recognizing gold's intrinsic value, are adding to their reserves. Investors, seeking to protect their wealth, are pouring into gold futures, ETFs, and other gold-related investments. While uncertainties persist, one thing is clear: gold's status as a safe haven asset is secure. As we navigate the uncertainties of the 21st century, gold will continue to shine as a beacon of stability and wealth preservation.